Hello and welcome to Moneylife News and Views. I'm Debashis Basu. A few days ago, India's former economic advisor floated an interesting theory in a column he wrote for a business paper. His main points: India's stock market has become unusually attractive for foreign investors. If only the billion-dollar global funds with the best of talent and all the resources in the world, if only they would wise up, they can grow their investment 8 times in dollar terms over the next 2 decades. Yes, 8 times over the next 2 decades. According to this theory, thanks to continued structural reforms, improved labor productivity, higher female labor force participation, transition from an informal to a formal economy, and deeper credit penetration, India will enter a prolonged period of high growth, low inflation, and minimal currency depreciation. This is a golden age of prosperity that foreign investors would miss only at their own peril. The proposition rests on two heroic assumptions. One, India can sustain 8% annual growth for decades together. And two, inflation will remain subdued enough to prevent a meaningful depreciation of the rupee. Now, both these assumptions are suspect. In fact, the second one about currency is not even correct, judging by the past. First, that easy peasy 8% growth. In theory, almost any economy can grow at 8% for a few years. Doing so for decades together is actually extremely rare. It requires policy continuity, relentless implementation, and an ability to course correct when things go wrong. There are just too many hurdles in the 8% dream. The most immediate is the weakness of private capital expenditure. During the boom preceding the 2008 global financial crisis, India's investment rate rose to almost 38% of GDP, supporting several years of rapid expansion. In fact, it's a big question whether we would need or want that kind of an expansion, because all those that capital expenditure only meant on the other side was huge amount of bad debts for the banks. They were, as an economist would call it, malinvestment. Nevertheless, since then, it has slipped back to below 30s. So quite possibly, India's private capital expenditure, is what we are seeing today, is actually the real normal. If you really want to push it up, you're probably going to get malinvestment. Public spending on infrastructure, which has taken up the slack for private spending, has risen sharply, but the government investment alone cannot replicate the dynamism of the broad private investment cycle. Many firms remain cautious, wary of uneven demand and uncertain global environment. Second, a large share of India's workforce remains tied to agriculture, a sector that generates far smaller share of national output. Manufacturing historically absorbs surplus rural labor during periods of rapid development. This has been the story in countries like South Korea, Taiwan, Japan, China, and so on. All these countries achieved growth above 8% by shifting millions and millions of workers into factories which were actually export oriented factories. India can no longer follow the successful model of low cost labor intensive export manufacturing. Our costs are just too high, our labor hardly productive, and which is why, as you can see, exports are hardly growing. That opportunity, which is export driven, manufacturing export driven growth, is really gone, or India is not up to it. India, by contrast, has leaned heavily on services, which employ a smaller slice of the workforce. The result is an economy that grows respectively without generating enough formal, high productivity jobs. So the dream of 8% based on manufacturing and high labor productivity is based actually on a false premise. Third, while educational attainment has improved, the quality of schooling and the alignment between skills the industry needs and what the labor is able to supply remain very, very wide. Meanwhile, the machinery of the state, though capable of executing ambitious reforms, often struggles with the slower work of implementation. Let's put it very politely. The fact really is that this nation, the state, does not have the capacity, nor is focused enough, nor is passionate enough to implement what is actually needed in India. In fact, on top of that, we have regulatory complexity, patchy contract enforcement, administrative fragmentation across states, which can delay projects and deter investors. Even after the introduction of goods and services tax intended to knit the whole country into a single market, businesses still grapple with compliance burdens and bureaucratic complexity. Fourth, infrastructure has improved in recent years, particularly in roads, airports, and digital payments, but serious bottlenecks persist in logistics, urban planning, and electricity distribution, areas that influence productivity across the economy. Fifth, India's urbanization quality is extraordinarily poor, and that is really limiting the productivity gains that dense cities typically are able to generate. Sixth, financial markets present another constraint. Although the banking system is healthier than it was a decade ago, access to long term project finance remains limited and the corporate bond market is shallow. Finally, India's earlier growth surge coincided with a period of buoyant global trade and capital flows. Today's world is marked by slower trade growth and rising geopolitical tensions, which complicate efforts to expand the export-led manufacturing. The country's growth story, therefore, rests increasingly on domestic reforms and investment. Without faster progress in shifting labor out of agriculture, strengthening human capital, and reviving private investment, sustaining 8% growth will remain an aspiration rather than a baseline. Now, let's come to the second point, the second pillar of this golden age of India theory, which is inflation and rupee. The theory that Dr. Subramaniam has propounded is that low inflation will prevent the rupee from depreciating meaningfully against the dollar. An analysis of the relationship between the annual depreciation of rupee against the US dollar and the annual CPI inflation rate from 2000 to 2024, that's 12 years, that's 24 years of data, they revealed an extremely weak to moderate linear correlation with a correlation coefficient of just about zero point 0.3, which means there is not a very strong correlation between lower inflation and a stronger rupee, and only about 9 to 10% of the variation in rupee depreciation actually can be linearly explained by inflation alone, because it's common sense. There are very many other influences which affect the rupee. For instance, global commodity prices, especially oil imports, capital flows, foreign investment trends, trade imbalances, monetary policy differentials between the Reserve Bank of India and the US Federal Reserve, RBI's active foreign exchange interventions to manage volatility, and external shocks like geopolitical events or global risk aversion. All these things have far greater impact on rupee, and the former chief economic advisor really oversimplifies things when he says just because inflation is under control, rupee will not depreciate much. Episodes of sharp depreciation in the past have often aligned closely with capital outflows or oil spikes than with domestic inflation trends, while periods of rupee appreciation has occurred amid strong inflows even when inflation was moderate. Clearly, the vision of effortless prosperity, 8% growth, low inflation, and a steadily strong currency is appealing, but as an investment thesis, it is charmingly simplistic and naive. Foreign investors who have real money at stake and have sold nearly $20 billion of Indian equities over the past 14 months may appreciate the complexities much better. They will certainly return, there's no question about that, but only when the arithmetic improves, not because armchair economists have declared a golden age based on very some simplistic assumptions. If you like this video, please do subscribe and share. Thanks for watching.